Today we're diving into a company that sits at the absolute epicenter of the entire tech universe. Our analysis target is TSMC. That's Taiwan Semiconductor Manufacturing Company, ticker TSM.
Welcome to Cyber Stock Reports. Today, we're going to decode the mystery behind TSMC. As you can see, our analysis is based on data as of December 12, 2025. And just a quick reminder, the disclaimer's on the screen. This is an AI-powered simulation, and it is absolutely not financial advice. Please invest at your own risk.
All right, let's jump right into the big question, the real puzzle with TSMC. You've got this massive disconnect. Their most advanced chip capacity is completely sold out for years to come. I mean, that's a sign of flawless execution. So why on earth is it stuck with a neutral B rating? What is the market seeing that we might be missing?
To start unraveling that, we have to begin with the bull case. And for a company like TSMC, the bull case really comes down to one thing: their absolutely positively unbeatable competitive moat. Now, for anyone who might be new to the term, a wide moat is just a fancy way of describing a company's long-term competitive advantage. It's the thing that keeps the competition from eating their lunch. But for TSMC, we're not just talking about a moat here. The data suggests it's more like a technological abyss that rivals just can't seem to cross right now.
So here's the really crucial point. This moat isn't just being built by TSMC's own genius. No, it's getting wider and deeper because of something we're calling competitor capitulation. To put it simply, their rivals are just stumbling badly.
And this slide just lays it out perfectly. First up, supply chain intelligence shows Samsung is seriously struggling with its 2-nanometer process. Yields are stuck below 60%. That's a huge problem. And what's the domino effect? Well, a giant customer like Qualcomm is now reportedly shifting its next-generation chip orders exclusively to TSMC. You add Intel's ongoing restructuring into that mix, and TSMC is pretty much becoming the only game in town for the best of the best chips.
Now, what's really fascinating is how all that dominance translates into cold, hard cash. Look at this. We're tracking an operating margin of nearly 60%. What that means is, for every single dollar in sales, they get to keep almost 60 cents as profit before interest and taxes. Just look at the massive gap between them and the industry average. This is what a monopoly on cutting-edge tech actually looks like on a spreadsheet.
This kind of dominance creates something incredible: pricing power. I mean, with customers having literally no other place to go for this level of performance, our models are projecting that TSMC could jack up prices by 50% and probably not lose a single customer. That's what we call an inelastic product. Demand just doesn't budge, even when the price goes through the roof.
Okay, so if the business is that perfect, we have to ask ourselves, what's the blind spot? What's the catch? And that brings us to the bear case, or what we've dubbed the wall of worry. Because while the bull case is a fortress, there are some pretty powerful waves crashing against its walls.
The first crack in that wall is the valuation. The stock is trading at a rich 31 times earnings. What that really means is its stock price is 31 times its annual profit per share. When you get a multiple that high, perfection is already priced in, which leaves almost zero room for any kind of slip-up.
And because of that, our model actually factors in a pretty significant correction. You might be asking why. Well, it's because even a company as amazing as TSMC doesn't live in a bubble. It's caught in this powerful market tide right now that's pulling money away from these high-flying tech stocks. And that tide is joined by some very real, specific headwinds. You've got anxiety simmering over potential 25% U.S. tariffs. There's the constant background noise of trade friction with China. Then, internally, we're seeing reports of a culture clash at their new Arizona facility. And to top it all off, you have this lingering concern over trade secrets potentially leaking to Intel. Every single one of these adds another layer of risk and uncertainty.
Okay, time to bring it all together. Let's put all the pieces on the board and land on a verdict. What we have here is a perfect business, clashing with a really difficult, uncertain environment.
So let's just put it on the scales. Nice and simple. The bull case, it's built on a pure monopoly, competitors messing up, and just immense pricing power. But weighing directly against that is the bear case. A super high valuation, sector headwinds, and a whole list of very real geopolitical risks.
You know, if we had to boil this entire complex analysis down into just one single sentence, this would be it. A great, world-class business, but a very, very crowded trade.
So the data-driven conclusion our analysis comes to is a neutral/hold rating.
We simply have to respect that valuation wall and the pressures hitting the entire sector. The data suggests that this is an absolutely fantastic company to own, but the prudent move might be to wait for a better entry point, maybe after the sector cools off or a dip caused by some of those macro fears.
And this leaves us with a final crucial question you really have to ask yourself. For a company that is, for all intents and purposes, the bedrock of the entire AI revolution, is the biggest risk the business itself, or is it simply your timing? And finally, as always, please remember this is an AI simulation. The final investment decision you make is yours and yours alone.